That's important because when U.S. Treasury Secretary Scott Bessent under President Trump in the United States did the same thing starting July 4th when the debt ceiling was raised. He had to raise $1 trillion to refill the Treasury's general account. He didn't have this reverse repo program with $2.5 trillion sitting in it to tap to basically nullify this negative liquidity effect. And so between that and the Fed's program of quantitative tightening, where they basically are reducing the size of their balance sheet, we're talking about close to $1 trillion was taken out of the dollar money markets from July to the present moment. And that is essentially the negative drag from a liquidity perspective on Bitcoin and other risky assets. Now, in the stock perspective, it's really the AI hype and bubble that's kept the stock market elevated. And in Bitcoin's case, it was the ETF flows and this DAT flows that we just spoke about that really counteracted this negative liquidity effect.
Hey guys, welcome to Everyday Finance. Rather than being led by charts or short-term sentiment, Arthur Hayes contends that the market is failing to recognize a significant macro shift that is being driven by politics and liquidity. Regardless matter who wins the upcoming election cycle in the United States, he believes that substantial liquidity injections would be required due to the fact that deficits, inflation pressures, and dropping real rates will all be present. It is his belief that this flood of money printing will be the driving force behind a historic cryptocurrency meltdown. With Bitcoin perhaps hitting $500,000 by the end of the year 2026, Hayes maintains that the bull market is not finished. Rather, it is reloading, and that the actual acceleration phase may just be beginning. This is despite the fact that recent turbulence has occurred.
Well, I think if you take a look at, I have an index on Bloomberg if clients have access to that. It's the US dollar liquidity index, and it's essentially a combination of certain indicators on the Fed's balance sheet, which was published every week, and then certain indicators from the US commercial banking system. And the reason why, at least in 2025, I've been really focused on the United States is the other three large money printing protagonists, the EU, Japan, and China, haven't really been doing all that much. And it's really been about the United States and everyone's reaction to what the United States has done. And so that's why I've really focused on this particular economic block for, the whole year. And when we talk about the dollar liquidity, my chart basically showed that, year to date, there's been an actual reduction, a net reduction in the amount of dollars circulating, at least by my index that I look at, and I use to guide my investing over the year. But what we saw from sort of April 9th until, October was Bitcoin hitting an all-time high. And this was driven by, I think, people misunderstanding what's going on in the ETF space, especially the IBIT ETF, the BlackRock Bitcoin ETF, the largest ETF out there that tracks Bitcoin, and the digital asset treasury company space, the DAT space, and the issuance of debt and stock to purchase Bitcoin. And these two things essentially added the impression that there's this big institutional bid for Bitcoin, and therefore the Bitcoin sort of ignored the fact that about $1 trillion was removed from the dollar liquidity markets at least from July until the present. And basically, once the ETF inflows switched to net outflows and DAT companies went from trading at premiums to trading at par, if not a slight discount, then Bitcoin basically fell down to where it should have been based on the dollar liquidity situation. Kind of. I mean, take the ETF, for example, because this is one of the most shown charts that inflows every day on X and other social media platforms. And people say, hey, look, Wall Street, retail, they're piling into these ETFs. And yes, that is true. But as traders and investors, we care about who is the marginal buyer and seller of a particular asset. What are the flows? And so, I have my trusty Bloomberg chart up here. You put up an HDS, the largest holders of the IBIT ETF on Bloomberg, or whatever platform you use, you'll see, and I'll name them here, Brevin Howard, Goldman Sachs, Millennium, Avenir, Jane Street are the largest 5 traders of this thing, right? There's a chart in my recent essay.
That's right.
And, if you understand anything about what these businesses are, they're either, multi-strat pod shops who trade hedge funds, they're global investment banks, and one of them is a family office for the founder of Huobi, Avenir. And so these entities are not places where they're just going to go long Bitcoin. Like Izzy doesn't give a fuck about Bitcoin. Alan Howard loves Bitcoin, but it's not like the key thing in his Brevin Howard asset management company where he manages clients' money. What they're in the business of doing is borrowing money and finding great ways to deploy that with, high Sharpe ratios. And that would be a basis trade. So what are these guys doing? They're taking the IBIT ETF, they buy it, they pledge it with their broker, then they sell a futures contract on the CME against it, and they were making, let's call it 7 to 10% per annum on that trade. They fund at Fed funds at, was it 4-ish%, and they lever it up, and that's a great levered return for these type of investors. Now, as that funding rate declines, and it has declined in September and October, then these traders unwind this position by selling the ETF and buying back their futures contracts. So during the summer, we saw massive net inflows driven marginally by these large players. And then as soon as that basis fell, especially after October 10th on the massive liquidation event, then you see net outflows. And so the retail thinks, oh no, institutions love Bitcoin in the summer and now they hate it in the fall. Therefore, I need to get rid of my exposure as well, not understanding what was driving those flows in the first place. And then on the DAT space, if you have a low MNAV or even at a discount, it's very difficult to issue corporate securities and purchase Bitcoin in a net positive accretive manner for your stock. And therefore, either you stop doing it altogether, you slow down, or you start selling Bitcoin and buying back your shares if you're trading at a discount, which again removes this impression that there's this new cohort of assets or of capital that is coming into the Bitcoin space. So when we remove those two things, and then I post that, you posted my chart of the difference between the price performance of Bitcoin and the percentage change in the dollar liquidity, then Bitcoin says, okay, I'm going to react to where I should have been absent the shimmer of these flows. And that's the move from 125,000 to 80,000. There's a pod, and a pod has a funding strategy mandate, right? These guys have equity, long, short. They have all sorts of different strategies. There's a portfolio manager, and their team will put on these types of funding trades. Could be bond RV. This is, it's a basis trade. It's a very standard trade, across all different types of ETFs that you can do. I buy the ETF and I short a future on the underlying and I trade the difference. And this is like, I used to do this as a career back in the day as well. So it's a very easy trade, especially when you can fund very cheaply at Fed funds. And then essentially you double the interest rates that you receive and you look like a hero because again, you're just trying to make 10%. If you make 10% for Izzy, you're making $50 a year. So this is what you need to do.
Right. Yeah. So and that funding rate goes down. Why? You said that already, but I just want to understand that.
As the price declines, then the funding rate collapses.
The notion that cryptocurrency is currently experiencing a bear market is refuted by Arthur Hayes, who asserts that the recent 15 to 35% downturn is a regular cycle volatility that is caused by temporary liquidity limitations in the United States and not by insufficient demand. According to him, the halt in liquidity that has occurred as a result of political deadlock, Treasury and Fed issues has only been temporary, and he expects that it will return stronger. Hayes further adds that the crash that occurred on October 10th was not the result of manipulation, but rather a lever-driven liquidation cascade that was triggered by misconceptions of exchange mechanics. Despite the fact that the tragedy affected the trust of traders and decreased their participation, he believes that the lingering fear is presenting significant possibilities for investors who are well informed in advance of the next rise higher.
I don't know the percentage. I don't know the percentage, but just judging by the type of firms that are in the top 5, I know that they're not long only investors of crypto. This isn't like it's Texas Teachers or XYZ or Ontario Teachers Pension Fund buying Bitcoin if they're the number one holder, right? If that was the case, then my argument would not be valid. But when you have Brevin Howard, Goldman Sachs, and Millennium as the top 3 holders, they're not in the business of taking just going long Bitcoin. That's not their business. Their business is doing these types of trades. So in 2023 and in 2025, there is a political theatrical fight about the debt ceiling in the United States, where both in 2023 it was the Democrats in charge. In 2025 it was the Republicans in charge. Same issue. One side wanted to spend a bunch of money and raise the ceiling. The other side tried to feign that they gave a fuck about fiscal responsibility, and so they fought the opponent. And then at the end of the day, of course, the government's not going to go bankrupt itself by not paying out. So they raise the ceiling. But all the while that this debate, this fight goes on, the Treasury has to spend down its checking account. And when the U.S. Treasury, or any Treasury department for that matter, spends down their checking account, they're adding fiat liquidity to the system. And so this is helps the markets. But as soon as the ceiling is raised, now the Treasury needs to refill its bank account. And by doing that, they issue debt. And instead of spending that money that they raise from the market, they keep it in the bank. And that extracts liquidity. So in 2023 and in 2025, it was June in 2023 and July in 2025, you had in the order of, half a trillion to $1 trillion that needed to be raised by the U.S. Treasury. And so as they start to do this, then the dollar liquidity contracts, and this has an adverse effect on all types of risky assets, Bitcoin and stocks predominantly. Now, in 2023, this led to sort of a 20% sell-off pretty quickly in the S&P. The 10-year yield was rising almost close to 5%. And again, the goal of every administration in the United States and every government around the world is to keep the stock market high because they earn taxes and makes the rich people feel good and all these sorts of things. So Janet Yellen had to find a way to juice the markets. Now, back in 2023, there was this facility at the Federal Reserve called the Reverse Repo Program, and it had $2.5 trillion of funds basically left over from the COVID stimulus era that was sat inert on the Fed's balance sheet. So what Janet Yellen did was said, okay, I'm going to issue more Treasury bills, short-term Treasury debt, less than 1 year maturity, and such a quantity that the yield is going to rise so much so above the reverse repo yield that it'll entice those funds to take that money out of the Fed's bank account and put it into the financial markets by lending it to the U.S. government, which then goes and spends this money. And so from 2023, third quarter, until essentially January 2025, Janet Yellen's Treasury injected $2.5 trillion of liquidity into the US dollar money markets. And that is essentially the reason why everything across the world ripped. Bitcoin, stocks, gold, housing, whatever, right? That is the reason for that bull market. And that sort of ended in early 2025. That's important because when U.S. Treasury Secretary Scott Bessent under President Trump in the United States did the same thing starting July 4th when the debt ceiling was raised. He had to raise $1 trillion to refill the Treasury's general account. He didn't have this reverse repo program with $2.5 trillion sitting in it to tap to basically nullify this negative liquidity effect. And so between that and the Fed's program of quantitative tightening, where they basically are reducing the size of their balance sheet, we're talking about close to $1 trillion was taken out of the dollar money markets from July to the present moment. And that is essentially the negative drag from a liquidity perspective on Bitcoin and other risky assets. Now, in the stock perspective, it's really the AI hype and bubble that's kept the stock market elevated. And in Bitcoin's case, it was the ETF flows and this DAT flows that we just spoke about that really counteracted this negative liquidity effect. It's essentially it reached about $1 trillion. At the time of this recording, they haven't released their most recent weekly updates. I don't know where it is now, but last week it was about 900 billion, coming down slowly. So the TJ will probably go to something around 850 billion, which is the target that the Treasury set for how much they're going to keep at the Fed. But more importantly, especially for this time around, it's the cessation of quantitative tightening at the Fed. So this program that the Fed started running in 2022 of reducing their balance sheet is over. Now the balance sheet will be kept constant. And obviously, most analysts believe that the Fed is going to restart quantitative easing at some point for whatever justification that they give. It doesn't really matter. All we know is that we have essentially bottomed on the liquidity chart. And the direction in the future is higher. And so that's why I believe that the $80,000 dip on Bitcoin recently is the bottom. And now we're going to have a supportive liquidity situation, at least marginally on the dollar. And we're bottom here and can go higher.
According to Arthur Hayes, the cryptocurrency industry will eventually be dominated by just 5 projects: Bitcoin, which serves as an impenetrable collateral; Ethereum, which serves as the institutional settlement layer; Solana, which is designed for high-speed consumer use; and Scash and Athena, which are designed for privacy-focused programmable finance initiatives. He contends that the majority of other tokens will become obsolete as liquidity and attention shift toward assets that have genuine demand in users. a pattern that has been observed in every previous cycle. Hayes considers this consolidation to be positive, which enables deeper liquidity and more conviction. He does not consider it anything but bullish. As he looks ahead to the year 2026, he forecasts a significant repricing in which the Magnificent Five would absorb large amounts of cash from throughout the world and transform the cryptocurrency economy.